Check out the official numbers and everything looks fine with the global bond market. Auctions are going through, yields are moving around but staying stable, and the news keeps telling us that countries can still borrow money easily. But when you dig into the actual transaction records from the past 6 months and remove all the complicated jargon, you'll find something absolutely terrifying that mainstream financial news refuses to talk about. We've arrived at 0 hour. This is what economists call a singularity, the point where the government printing the money becomes the main buyer of its own debt. The U.S. Treasury, European Central Bank, and Bank of Japan aren't working in a real market anymore. They're trapped in a loop where they're basically eating themselves alive. The bond market used to be the biggest, most liquid pool of money on the planet. Now, it's dried up. What you're seeing is fake propped up by computer trading algorithms and forcing rules. Let me explain how we got here. You need to understand the auction failures from late 2024 and early 2025 in a normal, healthy market. When the U.S. government needs to borrow $100 billion, it holds an auction. Investors from everywhere, pension funds in Tokyo, insurance companies in Switzerland, and sovereign wealth funds in Saudi Arabia come to buy. They purchase this debt because they see it as secure. But starting in late 2023, these buyers started disappearing. The bid-to-cover ratios, which show how much demand there is, dropped to scary levels. The tail spread on auctions. The gap between what yields should be and what they actually are got wider. The market was shouting, "Oh no!" In a real free market, when an auction fails, interest rates would jump to 10% or 15% to bring in new buyers. But the U.S. government can't handle 10% interest on $36 trillion of debt. That would eat up every single tax dollar collected, causing immediate government bankruptcy. So they activated the 0 hour protocol. This is the hidden rule that makes the primary dealers big banks like J.P. Morgan, Goldman Sachs, and Citigroup step in and purchase the debt nobody wants. They're legally required to be the backup buyers. But here's where it gets crazy. These primary dealers are already maxed out. Their books are stuffed with losing bonds they bought in 2022 and 2023. They can't take on more bad debt. So where do they find the money to buy new debt? They get it from the Federal Reserve. Through complicated systems like repo facilities, repurchase agreements, and emergency lending programs, the Fed gives money to these banks, who then use it to buy government bonds. The Fed is literally creating money, giving it to a middleman, the bank, and telling that middleman to buy the government's debt. It's hidden money printing. It makes it look like there's real demand. The headlines say, "Treasury auction successful." But what's really happening is the government just bought its own debt using a stand-in. Imagine a restaurant where the owner keeps the business alive by eating every meal himself and paying with money stolen from his own cash register. That's what this is. This closed system creates a zombie market. The 10-year Treasury bond yield, the most crucial number in global finance, isn't a real market signal anymore. It's controlled, it's rigged. Since the central bank is the main buyer, they decide what the yield is. This destroys the usefulness of the market. Historically, when bond yields went up, it was a warning from the market. Bond vigilantes, these were investors who would punish governments for spending too much. Today, those vigilantes are gone. The central bank eliminated them. This removes any spending discipline from the government. Politicians know that no matter how much they spend, the 0 hour system will make sure someone buys the debt. That's why government deficits are exploding even when the economy appears to be growing. We're watching fiscal dominance happen, where the central bank loses its independence and becomes just another department of the Treasury, existing only to help the government spend money. But the scariest part of 0 hour is how it pushes out the private sector. Because banks are forced to fill their balance sheets with government debt, they don't have room to lend to actual businesses. Small companies can't get loans. Home mortgage rates stay expensive compared to treasuries. The credit flow to the economy dies. We get stuck in a weird situation. The government gets flooded with cash from printing money, but the real economy can't get credit. This is what happened to Japan, but we're doing it way faster. In Japan, this took 20 years. In America and Europe, it's happening in 20 months. Money stops moving in the real world while shadow banking explodes. Also, this protocol marks the death of the risk-free rate. For a century, U.S. Treasury bonds were considered completely safe because the government could always tax people to pay back the debt. But when the interest payments become bigger than tax collections, which happened in 2024, the math doesn't work anymore. The only way to pay the debt now is to print more money. This changes the risk from default risk, not getting paid, to debasement risk, getting paid in worthless money. Foreign central banks understand this. That's why China is selling treasuries. That's why BRICS countries are stockpiling gold. They know that 0 hour means these bonds aren't assets anymore. They're certificates of theft. They're leaving the theater while the primary dealers are forced to block the exits. The terrifying truth for regular investors is that your entire portfolio probably depends on this broken number. Your stocks are valued using the 10-year Treasury yield. Your mortgage rate is based on the 10-year Treasury yield. Your pension fund calculations use the 10-year Treasury yield. If that yield is fake, if it's being artificially kept low by the 0 hour protocol, then every asset you own is also incorrectly valued. We're reliving inside a bubble that only stays inflated because the central bank is willing to swallow the entire bond market. And like every closed loop, it works perfectly until it breaks. The second the money printing stops, or when the inflation from this printing becomes politically unbearable, the loop shatters. And when the snake stops eating its own tail, it dies. To understand why we can't escape this trap, you need to look at the Federal Reserve's internal mechanics. Especially a tool most people have never heard of but has been keeping the U.S. economy alive since 2023, the Reverse Repo Facility, or RP. Think of the RRP as the extra cash cushion of the financial system. When the government printed trillions during the pandemic, that money needed somewhere to go. It landed in money market funds, which parked it back at the Fed in the RRP, earning easy interest. At its highest point, this facility held over $2.5 trillion. It was a massive reservoir of cash. For the past 2 years, every time the U.S. Treasury issued debt that the market rejected, the system pulled cash from this reservoir to buy it. The RRP worked as a hidden buyer, soaking up bonds without crashing bank reserves. It was a magic trick that let the government run huge deficits without spiking interest rates or destroying the banking system. But in 2026, the reservoir is bone dry. The RRP balance has basically hit zero. This is literally the 0 hour. The cushion is gone. Now, every dollar of new debt the Treasury issues must pull a dollar directly from bank reserves. Bank reserves are like the blood pressure of the financial system. When they fall below a certain level, estimated around $3 trillion, the banking system starts breaking down, repo rates explode. Banks stop trusting each other with loans. We got a preview of this in September 2019 when the repo market collapsed overnight, forcing the Fed to step in. But this time, the problem is 10 times bigger. The Treasury needs to issue $2 trillion of new debt this year just to function. With the RRP empty and foreign buyers selling, the only buyer left to absorb that $2 trillion is the U.S. banking sector. But the banks are already full. They resitting on hundreds of billions in unrealized losses from their existing bond portfolios, the same problem that killed Silicon Valley Bank. If they're forced to use their precious reserves to buy more Treasury bonds, they'll become technically bankrupt. The system has only 2 options. Option 1, let interest rates climb. To bring in real buyers, yields would need to hit 8% or 10%. This would immediately bankrupt both the U.S. government through interest costs and the commercial banks through mark-to-market losses. Option 2, yield curve control, or YCC. The Fed officially fixes the bond price. They'll pick option 2. They always pick option 2. Yield curve control is the official version of the 0 hour protocol. It's different from quantitative easing or QE. In QE, the Fed says, we'll buy $100 billion of bonds this month. They set the amount and let the price move. In YCC, the Fed says, we won't let the 10-year Treasury yield go above 4.5%. They set the price and let the amount move. To defend this price ceiling, they must print unlimited money to buy every single bond the market tries to sell at that price. If the market wants to sell $1 trillion, the Fed prints $1 trillion. If the market wants to sell $10 trillion, the Fed prints $10 trillion. The central bank's balance sheet becomes the trash dump for all the world's unwanted government debt. This shift to YCC triggers something called the iron triangle of finance. You can only control two of these three things: bond yields, interest rates. Exchange rates, currency strength, capital flows, free movement of money. If the U.S. chooses to control bond yields through YCC and keeps capital flows open to stay the global reserve currency, they lose control of the exchange rate. The dollar must crash. It's mechanical, there's no way around it. If you print infinite dollars to keep bond prices high, the value of the dollar compared to real assets, gold, oil, land must collapse. This brings us to the social disaster of this protocol, the Cantillon effect. This economic principle shows that money isn't neutral. When the Fed prints money to buy bonds from banks, that fresh money enters at the top of the pyramid. Banks, hedge funds, and private equity firms get it first. They use it to buy assets, stocks, tech companies, luxury real estate. By the time money reaches the wage earner, prices have already gone up. The rich get asset inflation. Their wealth increases. The poor get price inflation. Their grocery bills increase. YCC turbocharges this wealth transfer to criminal levels. It basically guarantees that asset owners get bailed out while currency holders get destroyed. It creates a split society where the gap between the haves' asset owners and the have-nots' wage earners becomes an unbreakable concrete wall. The stock market hits record highs while homelessness explodes. We're already witnessing this. The Dow Jones is at all-time highs while food bank usage is also at all-time highs. This isn't a contradiction. It's a system working exactly as designed. 0 hour makes sure the government can keep spending and banks can keep trading while the cost gets hidden in the declining living standards of working people. But the most evil victim of this protocol is the pension system. Pension funds are trapped. By law, they must hold a big chunk of their money in safe government bonds. In a free market, a pension manager would look at a U.S. Treasury bond paying 4.5%, while inflation runs at 8% and say, "No thanks, that's a guaranteed loss." But under financial repression, they're forced to buy. Regulations like Basel III and Solvency II basically require institutions to load up on government debt to meet capital requirements. This turns pension funds into the ultimate bag holders. They're being forced to buy the assets that smart money and foreigners are dumping. The Fed buys bonds to set the price, and regulations force pension funds to buy bonds to fund the government. It's a circular firing squad where retirees are standing in the center. When you see your pension statement showing a safe allocation to bonds, you're actually looking at a portfolio of unpayable IOUs, being kept at an artificial price by a central bank that's rapidly losing control of the currency. 0 hour isn't just a technical banking issue, it's the liquidation of the middle class as future to pay for today's bankruptcy. The appearance of stability only exists because the public doesn't understand the difference between nominal value and real value. The government will never default. They'll pay every penny of that $36 trillion. But those pennies will be worthless. The 0 hour protocol is the engine of this nominal payment but real default. Is how they allow strip mine the buying power of your savings to prevent the bond market from exploding. In the final section, I'll show you how to escape this trap. Because while the door is closing, it's not locked yet. There are assets outside this closed-loop assets the Fed, and print and pension funds are enforced to buy. Escaping 0 hour means moving from the inside money being destroyed to the outside money being revalued. The clock has hit 0. Time for theory is over. Call to action. The rollout of the 0 hour protocol isn't just a technical monetary policy tweak, it's a declaration of war on savers. For the past 40 years, the Western social contract was built on a simple promise. If you worked hard, lived within your budget, and saved money in a bank or government bond, you'd be rewarded with a safe, positive return. That contract has been ripped up. In a system of yield curve control and debt monetization, the saver is the intended victim. The central bank's goal is to keep interest rates below inflation to service the national debt. This gap, the difference between the 4% interest you earn and the 8% inflation eating your savings, is an accident. It's deliberate policy. It's a hidden tax called financial repression. The government is essentially draining purchasing power from your bank account to pay its unpayable debts. You're paying the debt not through higher taxes, but through the slow, invisible destruction of everything you've worked for. This reality requires completely flipping traditional financial advice. The wisdom that worked for your parents, pay off your mortgage, buy bonds, save cash, is now financial suicide. In a world where currency is being debased to keep the system running, being debt-free and holding cash is a losing strategy. The winners in the zero-hour economy are the borrowers. If you borrow money at a fixed 6% rate to buy an asset appreciating at the real inflation rate of 10% or 12%, you're effectively betting against the dollar. The bank is actually paying you to take the loan. Inflation destroys the real value of the debt faster than interest builds up. This is why ultra-wealthy people carry huge mortgages on their properties even when they could pay cash. They understand debt is protection against currency debasement. They're using the zero-hour system against the state. But playing this game requires owning the right assets. Most people are stuck in the financialization trap. Stocks, bonds, and ETFs in brokerage accounts. These are inside money. They're liabilities of the system. As I explained, they're vulnerable to rehypothecation, capital controls, and bail-ins. To escape the protocol, you must move a significant chunk of your wealth into outside money assets that exist independently of the financial ledger. Gold is the primary escape vehicle. It's the only financial asset that isn't someone else's liability. When the central bank prints money to buy bonds, they're diluting the currency. Gold, which can't be printed, adjusts its price to reflect this dilution. It's the anti-dollar. But the critical difference in 2026 is physical possession. The paper gold market, DTFS and futures, is part of the inside system. It's leveraged and vulnerable to collapse. The zero-hour escape route is physical gold bars held in your own possession or in a non-bank vault in a neutral jurisdiction like Singapore or Switzerland. This eliminates counterparty risk. If the banking system freezes or the bond market implodes, your gold stays accessible. It's the ultimate insurance against zero-hour loop failure. Bitcoin represents the digital side of this escape. While gold protects against monetary debasement, Bitcoin protects against monetary capture. In a world of central bank digital currencies, CBDCs, where the government can track and control every transaction, Bitcoin offers a parallel system. It's a bearer asset you can transport across borders in your mind. The zero-hour protocol depends on trapping capital inside the domestic system to force it to buy government debt. Bitcoin is the capital flight technology that lets wealth escape the trap. Bitcoin's volatility is the price you pay for its exit capability. Smart money sees this volatility not as risk, but as the chaotic repricing of a new global reserve asset being born in real time. Productive land is the third pillar. Farmland, timberland, and energy-producing real estate are assets with real-world utility. People need food, building materials, and energy regardless of currency value. These assets pass inflation through. If the dollar collapses, corn, lumber, and oil prices rise. The land producing them keeps its purchasing power. Plus, land is physical reality that can't be hacked or deleted. In the zero-hour scenario, where financial abstractions become increasingly untrustworthy, tangible reality commands a premium. But the most dangerous trap for individual investors is the passive index fund. Millions have their retirement on autopilot in S&P 500 index funds. They think they're diversified. They're not. They're betting on the Magnificent Seven tech stocks and the US dollar. The S&P 500 is heavily concentrated in companies benefiting from the financialization of the economy. If the zero-hour protocol breaks, if the bond market revolts and rates spike, stock market valuations will collapse. The everything bubble is built on artificially low interest rates. When that foundation cracks, passive investors will face a lost decade of negative real returns. You can't passively invest through a sovereign debt crisis. You must be active. You must go against the crowd. Zero hour also signals the end of global diversification through traditional methods. Buying a global bond fund or emerging market stock fund doesn't protect you. Most central banks worldwide are copying the Fed's playbook. The ECB and BOJ are running their own zero-hour protocols. The entire G7 is one synchronized debt bubble. To truly diversify, you need jurisdictional arbitrage. This means getting a second passport or residency in a country outside the G7 debt spiral. Countries in Latin America or Southeast Asia often have much lower debt-to-GDP ratios and healthier demographics. They're not forced to monetize their debt to the same degree. Having legal standing in a jurisdiction that treats you as a customer rather than a tax target is life insurance for your freedom. The psychological barrier is the hardest part of this shift. We're conditioned to trust institutions. We're taught the Federal Reserve is all-powerful and U.S. Treasury is risk-free. Accepting that these institutions are bankrupt and actively predatory requires a painful mindset change. It means admitting the game's rules have changed and the referees are cheating, but denial is expensive. People who refuse to see the zero-hour mechanism will pay for it. They're the ones holding bonds as they become worthless in real terms. They're the ones keeping cash in banks as it loses 10% value yearly. They're the liquidity the system feeds on. Zero hour isn't the end of the world. It's the end of an era. The end of the 40-year bond bull market and the end of the U.S. dollar's unquestioned dominance. But for those who prepare, it's the greatest opportunity in history. The wealth transfer from paper to real assets will create a new wealthy class, the new pioneers I discussed in previous videos. These are people who understood the math, ignored the gaslighting, and positioned themselves in scarce, essential assets before the masses panicked. Central banks are buying their own assets because nobody else will. This is your signal to leave the room. The exit door is still open. The gold price is the alarm. The Bitcoin block clock is the countdown. Don't be the one left holding the bag when the printing press finally runs out of ink.